It's the 24th of June 2020. I'm going to have a quick look at the gold and oil chart. So this is a weekly chart for the precious metal gold. As you can see, we've been in a very good bull run ever since the middle of August from 2018. So it's been a good nearly 2-year bull run. Obviously, we've had our periods of consolidation, which is normal, and we had a lot of volatility around March with the outbreak of the coronavirus pandemic. But since then, gold has stabilized and managed to edge higher over the recent weeks anyway. As you can see, we're now starting to build some strength, and we can see that a little bit more clearly on the daily chart, where you can see, let's just open this up. So this kind of focuses on the March period when the coronavirus pandemic broke, and then the recovery. Now we had quite a significant sideways pattern here, which is normal for a bull trend. In a bull trend, you do tend to get significant periods of consolidation, and I'll put a trend line on there just to kind of emphasize where we had this consolidation. There you go. So we were trading sideways in this channel. Now, the previous high in June was 1764. Sorry, in May was 1764 for this recovery phase, and we beat that yesterday. Yesterday we got up as far as 1770, so this is a positive breakout. It indicates that the sideways consolidation could be over. Now we will have to test this trendline resistance up at 1781, 1784. This is going to be key resistance now, so if you're in a long position, that's where you want to be careful. If you're looking to take some profit, that would also be a very good area. See if we pull back, see if we get another consolidation phase where you would buy into a dip. But of course, if we start breaking above 1790, this is going to continue the bull trend, and eventually I think we will break higher. It's just a question of timing because we are in a strong bull trend. Now look, if I go back to the lower chart, longer term, I'll go actually now to the monthly chart. You can see if we break up through 1790, just going to have a look at where some of these candles are. Actually, 1795 would be the point to break above. You can see that this is the peak of this significant swing on the monthly chart at the end of 2012. We have got resistance up at 1790, 1795 from this peak. So once we're up through 1800, that certainly would be more bullish. But I would take a break above 1795 to signal that we'd broken those trend lines that I showed you on the daily chart. And then really, there is nothing to stop us going all the way to retest that $1,900 area, $1,900, 1920. So quite interesting times for gold at the moment. Having said there's interesting times for gold, crazy times for oil. Look at oil. Probably you're aware if you trade oil how we plunged to minus $40 on the March expiry. Was it March expiry? No, it was April expiry. Anyway. Since then, we've had an incredible recovery. I'm going to show you the daily chart now. Just rocketed after that crazy spike down on that expiry in April, and since then we've just climbed very, very steadily. It's been a really good market for the bulls. Crude is now trading. WTI crude is now trading August expiry. So I've just put it on August expiry to show you what's going on. Now this is the way I tend to break down a chart. I'll put some Fibonacci retracement levels from the major swing points, and you can see how actually they've tied in quite nicely with the moving averages. The blue moving average is the 100-day, the red is the 200-day, the green is the 500-day moving average. So things are looking pretty positive. Key points to note: we're testing the 50% fib at 41.25. We managed to get just a little bit above there yesterday. We got to 41.63, but that was rejected. We've got a very minor negative candle. The fact that we pushed higher but we didn't close up on the day, we actually closed down on the day, leaves us with a red-bodied candle. This is a doji. It indicates that there's a little bit more balance in the market, whereby sellers are matching buyers. So it shows more of a neutral outlook. And that's not particularly surprising when you consider how we've become overbought on the daily stochastics. So this 50% Fibonacci level at 41.25 is offering some resistance. You've probably noticed already that we've got a huge gap here to fill on the August chart at 42.17. So these are the levels that we've got to watch around the 41 and a quarter area. If we manage to break above yesterday's high at 41.63, if we get through 41.70, we can we can attempt to fill the gap at 42.17, but that should be quite a big resistance level, again, when you bear in mind how overbought this market is. Now, if we take this sort of neutral candle, it would indicate that we will probably trade sideways for a little while. This is normal in a bull trend, as I've said before. We have regular periods of consolidation, as you can see just in this oil chart alone. So don't be surprised to see us maybe trade sideways into the end of June. Downside should be fairly limited. We don't have any particular sell signal, so I think that shorts are risky at this time. We're in a strong bull trend, so I wouldn't necessarily suggest shorts, even though we are overbought. But if we do tumble, then we should find good support around the $36 area. If you're interested in finding out more about the services we provide, or myself, Jason Sen, please visit my website, daytradeideas.co.uk.